Hello, in this video I'm going to be talking about why most great investors don't short sell, and what short selling is just basically betting on the fact that a company is going to go down in the future, making money off it. That's the gist of it. Now, I'm a private investor. I've been investing my own money, my own funds for about 6 years now, and I've just sort of shared my thoughts and sort of bits I've seen sort of studying the best investors in the world and just like common stuff I spot amongst them. One of the things I've noticed that's really interesting is that most of these successful investors have really built wealth through investing long in the future rather than short selling. And I think there's a few things for this. And number one, structurally, short selling is very difficult to do. And what I mean by this is that generally, if the economy goes up, and if the economy generally goes up, technology acts as something that improves the rate of um, production and efficiency of people. And number two, we have inflation, where generally the cost of things go up regardless. Generally, that will mean that the prices of things, including the stock price, will generally go up because sales will normally increase, whether that's just through inflation and just general productivity increases, meaning that more will be spent on the product, which just could mean higher revenues and higher net incomes, even though it might not necessarily be taking market share. That will naturally lead to the price to appreciate, if it doesn't at least just appreciate in line with inflation at least. So generally, number one, you have that structural disadvantage where short selling, you're going against the general nature of stuff. So on average, I think everyone knows this, it's been repeated about 1,000 times on the internet already. The S&P average is about 7 to 10% historically over the last 50, 100 years, etc. And by you short selling, you're basically speculating that not only is it not going to go up, it's going to go down by a significant amount, which is very hard to do which is very hard to do. So A, the odds are against you. Number two is that the risk reward perspective just isn't that good. If you're short selling, I guess if you're buying puts, it's slightly different, but in general, if you're just short selling, meaning you make money when the thing goes down, your risk is to an extent infinite. Now, I know it's probably not infinite, but your maximum reward is only 100%. Whereas you could easily, I mean, Tesla short sellers have been burnt, and they've probably lost a few 100% of their position if they've gone into it initially. So there is significantly more risk you're left open to. Now, yes, it's unlikely, but that is another thing. Like with short selling, even if you're dead center right, the most you're going to make 100%. Whereas the best investors, if they're dead center right and they are truly what they think truly plays out, or their expectations are above what they think, then they have that room to go beyond 100%. You see many investors, particularly the greatest one, talk about their positions multiplying many-fold, 10x, even 100x for some of the greatest investors that have held over decades. Whereas in short selling, the most, even if this company surprises to the downside, again, is only going to be 100% gain there. So I think they're the main two things really that make it difficult. And the third thing as well is that the issue with short selling is because you have to pay to borrow that contract. It's almost going against nature in the sense that it's unnatural in the sense that you have to pay someone else to have the right to sell it and then be able to buy it back later, which means inevitably you can't hold a short position for 5-10 years, because at some point the cost of shorting that company just doesn't make sense to short. Now, it varies by the company and is different, but some companies it may cost upwards of 10% a year to just short the company alone. That can be relatively common actually. particularly for those with a high short interest. So that's something that you need to take into account, even if it's less shorted amongst others, and there's more liquidity there, but that is a real cost there that adds up and eats into your profit. Whereas someone that's going long, they can easily hold that company for 5, 10, 20, 30. I mean, heck, I've heard someone hold a company for 70 years that they've owned since they were 12 or something. And to me, that's another very significant difference. And I think that's why you really don't see the best investors sort of short companies on a frequent basis. They may do it as a hedge to protect themselves and mitigate volatility, but I think at that point they're not aiming to maximize return. Oftentimes they're just aiming to protect what they have. That's generally why I wouldn't want to short either. I think there's a lot more money to be made in going long, and the risk is that you can always mistime it, and even if you are right, it might only play out a year or two later. So thanks for listening. Hope you found it useful.